Welcome to this Stock Market Palantir. Today, we are going to talk about FTEL. FTEL Corporation has really captivated the microcap universe by pulling off one of the most radical corporate pivots we've seen this year. We're talking about an Australian fitness equipment retailer that was, well, essentially stagnant, which has now declared itself a Solana-focused digital asset treasury.
It really is the ultimate narrative change, swapping treadmills for meme coin utility tokens. And the question isn't whether it's bizarre, because it is, but whether this extreme maneuver is, calculated desperation or some kind of genuine strategy. Is this pivot a sophisticated, high-leverage play designed purely to exploit a volatile market structure for survival, or are we just watching the final desperate act of a structurally unprofitable company plagued by severe governance and solvency risks?
I hold that this is high-stakes financial engineering. It's a perfect storm where technical market mechanics are intentionally being leveraged to overcome what are, yes, undeniable fundamental weaknesses. The FTL management team, however questionable their history might be, is using the unique idiosyncrasies of the microcap environment, specifically the extreme short interest and that post-split low float, to create a liquidity event that's necessary to stabilize a balance sheet facing, well, existential threats.
And I come at this from the perspective that technical squeezes are, at best, temporary band-aids on a core cancer. Fundamental decay and, frankly, serious governance deficiencies predetermine this company's collapse. The narrative pivot is simply camouflage. FTEL is operating as a shell company, and its primary focus is creating transient liquidity for insiders and the predatory financiers underwriting their existence, making sure they extract value before the inevitable failure.
Okay, so let's start with the structure that makes my case plausible. After the 1-for-16 reverse stock split back in September of 2025, the float, the number of shares readily available for trading, is exceptionally small. This scarcity, which is arguably the company's biggest asset right now, is being felt directly by anyone shorting the stock.
And how is that scarcity manifesting itself?
In the cost to borrow, or CTB, we have seen short borrow fee rates just scream past 78%, topping out at over 92% APR throughout November. That cost to borrow makes holding a short position completely toxic and unsustainable over anything but the, absolute shortest time frame. It forces aggressive risk management, which is exactly what management is betting on.
But this high CTB is simply the market saying, look, we believe this stock's intrinsic value is effectively zero, and we are willing to pay almost anything for the right to hold that short position until the bankruptcy filing. You're focusing on the volatility play, but you're ignoring the reason management is forced into this corner in the first place. The original fitness business is hollowed out. The slight reported improvement in net loss, that was achieved by gutting the company, a massive 61.6% cut in operating expenses. They stopped investing in growth or even basic maintenance.
I agree the operational business is irrelevant now, but that hollowing out was arguably a precondition for survival. They stripped the asset down to its bare listing, ensuring minimal ongoing cash burn while maximizing the focus on the financial pivot. Solvency, as you mentioned, is the primary issue, and liquidity is the only fix.
And liquidity is exactly what the auditor flagged. The going concern qualification the auditor slapped on them is not a suggestion. It's a bright red flag indicating substantial doubt about the company's ability to remain solvent within the next 12 months. No amount of volatile trading can fix a structural hole that deep.
But volatility can provide the necessary exit velocity. The structural fragility you describe, combined with significant fails to deliver FTDs, which are mandatory buy-ins where the clearinghouse just can't locate the shares, suggests sophisticated short sellers are trapped. We saw nearly 200,000 FTDs on September 25th alone.
That volume of FTDs, given the small float, is certainly a concern for the shorts. But let's shift focus to the true toxicity of this new strategy, which brings us to the integrity of the, quote, Solana-focused digital asset treasury. How does the pivot itself, moving from dumbbells to pump tokens, address the going concern warning?
It's the narrative catalyst, pure and simple.
I'm sorry, but I just don't buy that the crypto pivot is a sound strategy, not even a desperation one. They spent $1.5 million of precious shareholder capital, cash they desperately needed for basic operations or debt service, on pump tokens. Pump is a utility token tied purely to speculative meme coin creation velocity on Solana. It's an asset that is designed to be volatile, but it possesses no fundamental value whatsoever. They swapped liquid rent money for high-risk lottery tickets, alienating every traditional investor they might have had.
But that's applying a traditional valuation methodology to a financial engineering maneuver. You're correct that it's not a prudent treasury strategy. It should be viewed as an enormous calculated marketing spend aimed squarely at capturing volatility. The goal is not long-term pump token returns. The goal is to generate massive headlines, attract the momentum trading crowd, ignite the short squeeze, that structural powder keg, and enable them to execute an at-the-market or ATM offering at a temporarily inflated price.
And that is exactly what makes the company fundamentally unreliable. They are betting the company's future on a pure pump cycle. And consider the accounting implications. Under the new FASB rules, they have to mark these volatile crypto assets to fair value every quarter. Their earnings reports will now be wildly unpredictable and disconnected entirely from the performance of the fitness business, which, however hollowed out, is still technically their core operation.
That volatility is the necessary friction. If the pump token price spikes 100% in a quarter, they book massive unrealized gains, instantly improving their book value and making that ATM offering far more attractive. It is a high beta shortcut to survival.
But the reverse is so much more likely in that space. A routine 50% drop in pump prices, a common Tuesday in crypto, would wipe out $750,000 of book value immediately. That one drop is more than their entire net loss for the prior fiscal year. They have introduced existential reporting risk. They are prioritizing trading opportunity over corporate stability.
They're choosing aggressive leverage over slow decay. The high risk is the key component of the high reward technical structure.
But governance risk compounds every other problem, which is our second major contention. Can any trading potential, however juicy, overcome institutional fraud risk? The Bleecker Street report is extremely specific. They allege a $2 million loan was made back in 2020 to a dissolved entity called ANSA Group Ltd.
ANSA Group Ltd, yes.
If that loan was never collected or repaid, it strongly suggests insider embezzlement or unauthorized asset stripping. Furthermore, the link between a current director, Guy Adrian Robertson, and the prior fraudulent collapse of Health Zone in Australia introduces serious concern. This is what we call recidivist risk, a pattern of corporate malfeasance. The fundamental integrity of the company is just destroyed by these links.
While the governance allegations are profoundly serious and absolutely devastating for any long-term fundamental holder, the aggressive trader focuses on market signals, and FTL has been actively sending signals to counter the short narrative. The $3 million share repurchase program announced in December 2025, despite their extremely limited cash position, is a direct psychological move intended to stabilize sentiment.
A $3 million buyback, funded by what? If they have under $3 million in cash, announcing a buyback program is a purely cosmetic action that can never be fully executed. It's theatrical window dressing.
Perhaps. But for an aggressive, short-term volatility play, governance risk is simply another form of volatility to be managed, especially when the board operates as a controlled company. This status allows the board to execute aggressive, rapid maneuvers, like the reverse split or the crypto pivot, without the typical independent oversight or slow shareholder approval processes that delay traditional companies. They can act faster than the market expects.
But they face a regulatory time bomb that no market signal can diffuse. The institutional failure risk is just too high. Look at their auditor, Excel Audit and Compliance. The Public Company Accounting Oversight Board, the PCOAB, inspected Excel and found a 100% deficiency rate.
100% deficiency rate. That is astounding.
It means that in every single audit the PCAOB reviewed, Excel failed to obtain sufficient evidence to support its audit opinion. This is not a technical violation. It is an existential threat. If FTL loses its auditor, it cannot file its Form 20F annual report. Missing that deadline means an automatic NASDAQ deficiency notice, leading eventually to an automatic delisting. This is the ultimate hard stop scenario C, and it overrides any technical short squeeze mechanic you care to name. The governance issues, the alleged fraud, and the certainty of losing their auditor are fundamental weaknesses that cannot be overcome by a pump token narrative.
That's a compelling argument regarding the auditor risk, and it absolutely underscores the desperation we're analyzing. But that desperation speaks precisely to why the technical structure is their only key to escaping. Let's pivot to our third contention, the true structural impact of the reverse split and the resulting dilution headroom.
The reverse split, 1-for-16, was done primarily for NASDAQ compliance, to boost the share price above the $1 minimum bid.
Yes, but its secondary effect was profound. The post-split price collapse, while catastrophic for the retail investors who bought pre-split with an adjusted cost basis potentially near $32, it created the perfect low-float environment needed for a parabolic move driven by forced covering. That low float, coupled with the 90% CTB rates, is the structural leverage.
I disagree on the primary purpose. Its structural purpose was to create massive headroom for dilution. They authorized 90 million shares post-split. This gives the board the capacity to issue stock to toxic financiers without any shareholder approval. This anticipated relentless dilution is what drives the persistent selling pressure.
Explain that mechanism for the audience. What do you mean by the dilution engine and the liquidity spiral?
Well, toxic financiers often use convertible notes. They'll loan the distressed company money in exchange for debt that they can then convert into shares at a steep discount to the current market price, sometimes 10 or 20% below the lowest price of the day. They immediately convert those discounted notes into stock and just dump the shares into the market for an instant profit.
And how does that relate to the short volume?
That selling pressure is often routed through dock pools off exchange to minimize its impact on the visible exchange price. This generates that high off-exchange short volume ratio, which peaked near 59%. That high dark pool volume is the exhaust pipe of the dilution engine. The more they borrow, the more they sell, the lower the stock goes, the deeper the discount the financier gets on the next note conversion, and the cycle just accelerates. That is the liquidity spiral scenario A, where the financing mechanism itself guarantees the long-term collapse.
Except that the mechanism you describe is a typical feature of microcap distress, and that toxic financing is almost certainly involved. But I would frame the dilution capacity differently. I see it as a necessary tool, not an inevitable outcome. They are running on a deeply distressed balance sheet. They need that 90 million share capacity to execute a massive, stabilizing raise if the short squeeze materializes. If the low float and high CTB dynamics drive the price to, say, $5 or even $10, they can raise $20 million with far less dilution than if they tried to raise it at the pre-split equivalent of 80 cents.
They are gambling that institutional fraud and regulatory collapse will hold off long enough for a technical miracle. They're leveraging volatility to postpone the inevitable, all while enriching the very people, the financiers, and possibly the insiders, who benefit from the structural weakness.
And my perspective remains that the confluence of factors, the high CTB, the engineered low float, the FTD pressure, and the aggressive, headline-grabbing crypto pivot creates a truly unique, high-octane trading scenario. The risk is immense, yes, but the technical leverage for a short squeeze that allows management to raise stabilizing capital is, I think, undeniable.
And I maintain the company is fundamentally bankrupt, plagued by alleged fraud surrounding the Ansel Group loan, structurally weak due to the hollowing out of operations, and facing down the certainty of regulatory failure because of the auditor's 100% deficiency rate. The volatility you perceive as opportunity is merely the death throes of a shell company attempting to use narrative and aggressive, continuous dilution to extract the last remaining value before the collapse.
So to summarize, we have explored the duality of FTL, debating whether its controversial pivot to a Solana-based digital treasury represents a necessary, albeit risky, strategic play to leverage market mechanics and escape insolvency, or if it is merely the final act of a structurally flawed microcap riddled with governance risks and relentless dilution potential. The material highlights this dramatic tension between technical trading opportunity and fundamental bankruptcy risk in the modern microcap market.
Right. We have discussed how FTL is a quintessential microcap anomaly, where powerful technical signals like low float and high cost to borrow are in direct conflict with severe fundamental warnings. These include a going concern qualification, a documented history of alleged insider misconduct, and the critical failure risk associated with their deficient auditor.
It is a phenomenal case study in market structure leverage versus corporate governance failure.
Indeed.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.